hoping that is coming through live, loud and clear. Awesome. Okay, sorry about the false start there, guys. That's the joys of doing these live streams, though, isn't it? So let's bring up some of these headlines. We're going to have a look at the charts and maybe take some questions at the end. But basically, we want to talk about these rising bond yields that gave the markets a little bit of a scare last night. So here you can see the US 10-year government bond yield, and it's on quite a run. So if we go back to March last year, so it's crazy to think how much the world has changed and how much has happened just in that past year. So this is the video I did from 20th of Feb 2020. Remember we spoke about the world has gone mad, how markets were still charging higher at the time? Let's go back to Feb 20th. Clear our charts. All right, so here we are. Feb 20 was literally here. So in Australia, it's the day before. So I recorded this video here and uploaded it that evening. So it had only been up less than 24 hours basically until markets started to crash. And the whole premise of that video was about how markets were just ignoring all these risks that were now out there, and they were becoming pretty clear that it wasn't just China that was going to have to go into lockdown. It was spreading across the world, and this would have repercussions. No matter what happened, no matter how bad it was going to have some sort of effect. And markets at record highs were pricing in, all roses. Nothing bad was going to happen. So obviously things got repriced pretty quickly. Now, when that happens, we spoke about this at the time. Where does money go? So money gets pulled out of a lot of these assets. So whether it's the stock market, Bitcoin obviously got hit really hard. Even gold and silver did at the time before bouncing back. Now, you can say the same about Bitcoin. Got hit really hard and then had a nice sharp bounce back as well. But it's the government bonds that we want to focus on again today. So here we are. Money had basically already started going into those bonds before the crash. So here we can see the date when I did that video, Feb 20, but the US government bond yield has already started to decline. And if you followed my videos and done all the tutorials, you'll know that bond prices and yields move in the opposite direction. So when these bond yields are starting to go down like that, it means bond prices have already started to go up. So people are buying bonds. Why are they buying a bond? You can think of it like a government savings account. They want to take their money out of stocks and risk assets and put it into the government savings account where they know they can get 1.5% or whatever it was at the time, basically risk-free compared to other things out there. Now, it's always been considered risk-free, but I guess the little caveat to that that's important to understand is that you're getting paid back in dollars. Now, the US is the world reserve currency, so that's never really been a problem before. But in the past 12 months, I think the stat is now they've created something like 70% more M1 money supply. And Jerome Powell got asked about this in an interview just last night. And so if we have another correction, which people are saying we might be facing one now, our thing is going to play out the same because everyone had this mad scramble to US government bonds because, hey, I can still get any sort of yield, even if it's 0.5%, and I get paid in the world reserve currency. That's better than sitting in my stocks and watching them get cut in half. So that's the basic premise around it. Here you can see the DXY, the US dollar index. So that sold off to begin with and then bounced back strongly as people, I guess, sought the safety of the world reserve currency. So since then, the US dollar's basically been declining. And the question now is, are we putting in a bottoming pattern? And so just last night, when stocks sold off again, as you see here, pretty sharp decline in that session. where was that money going? Well, it has started to go once again into the dollar. And let's just bring up the bond market. So yields have been rising for a fair while here. Like we said, bond markets they've been rising for a while here in terms of this fear of inflation. And just last night, they started to come off a bit, go down as people start to flood in and buy those bonds again. So this big run up and rise is markets starting to price in that inflation that central bankers are now welcoming. And I guess one of the big takeaways from this video I want you to understand is that are things different this time? So one of those reasons is the US as the world reserve currency. It's not as strong as it used to be. When any currency is printing 30, 40, 50% more of itself, people are really starting to ask questions. And we've already seen those big corporates that are putting Bitcoin on their balance sheet. That's their reasoning. Whether you think they're right or wrong, that's their reasoning. The next big thing I want you to try and understand is that around the world, everyone is doing this. So it's the cleanest dirty shirt in the laundry joke. But for the first time ever, we've got Bitcoin as an alternative. And if the dollar is no longer seen as that strong, it's just the default. Oh, you just go to the dollar, or you just go to the US government bond. For the first time ever, we've got this other asset class, which is now over $1 trillion in market cap. It is a serious option, and probably more so for the small or medium-sized investor. It's kind of great that we have an asset like that we can put in our portfolio, whereas the super big hedge funds, they can't yet. And that's one of the reasons why I think Bitcoin's got a lot of long-term growth, because eventually they will use it as collateral the same way as we currently can in our portfolios. But at the moment, that's an advantage for you. So the other thing we talk about is real versus nominal interest rates. So nominal interest rate is just the number on the screen. So when you go to get your home loan, or you go to look at your savings account, it says there's a 2% interest rate. But if the real interest rate, the real rate of inflation of food and everything else is going up, then it's not much good for you to put your money in a savings account and get 2% if the cost of food is going up 10%. And so that's how we can talk about the difference between real and nominal interest rates. And again, what we are now seeing in the economy is these real interest rates start to pick up a little bit. And that's reflected in those bond yields. And so all of a sudden, things like risky assets that we just touched on, particularly these tech stocks, they're starting to sell off and people are looking elsewhere. So yeah, we're in quite an interesting, unique situation that hasn't really happened before, I guess, in history, where the US dollar and the US government bonds are maybe not seen as safe as they used to be, particularly when you've got the long end of the yield curve, so like the 10 and the 30-year government bonds. These yields are also rising. So let's just bring up the 30-year. And we can see since the start of the year, where are we? So we've gone from 1.6, or we bottomed at August last year, 1.1 up to 2.3. So these are quite big increases when you consider how much debt is out there, and when interest rates have been taken to zero. So remember, the nominal interest rate on the screen that the Fed have set it at is zero, but all of a sudden, bonds and the price of, real inflation that markets are trying to price in at least is signaling, 2.3%. So there's a big spread. This is why gold has been performing so well, and crypto and stocks, and I guess everything really, because people don't want to lose that difference. They'd rather spend their money. So hopefully that all makes sense. But what investors are now worried about is that this is starting to get to the point where it might even be a little bit out of control. So the Fed, it's all well and good to welcome inflation and say they want the economy to run hot. But at what point do they say, well, we would have to step in and intervene if this continues? And last night, again, Jerome Powell didn't really give any warning about that, just said that we're quite happy with the way things are. We're going to let it go on like that. it's what's the word that they love? Transitory. Any inflation that we get is just mild and transitory, and so markets are starting to worry. They say, well, hold on, if inflation rates continue to go up at this pace, there's, we added 8 trillion in debt last year. We can't even service the interest on the debt if you keep letting these interest rates rise. And so that is the rock and a hard place that the Fed find themselves in. They can't really raise interest rates because everyone is under the mother load of debt. The same in Australia. Think about how much house prices would come off if we started to raise mortgage rates. And on the other hand, they can't really do anything else because they'd spur worse and worse inflation if they're dropping rates, or they're already printing more money. They're already buying like 120 billion a month in the bond market, and that's where people are saying, if the Fed are going to start to intervene and buy more bonds, again, to push down interest rate, buy bonds and push up the price, pushes down the interest rate. If the Fed start to do that, they're already doing like 120 billion a month. Now, at the same time, you've got Janet Yellen talking about starting to spend all that money that they've got in the Treasury account that they've built up over the years. And so there's just this wave of money that can be coming in to the system from all angles. This correlation chart I just want to show you. So we've started to see, all the commodities, lumber, oil, probably, gold not so much, but just basically the cost of everything is starting to go up, and that's reflected in food prices and then energy and all the way through. Now this correlation chart has got Bitcoin in it, which is great, and it shows you that Bitcoin's actually got the lowest correlation, so it's less correlated to other assets than even just cash, the US dollar. Then the long bond as well. So these are kind of the assets that people would traditionally turn to. And Bitcoin is, if you're looking for an uncorrelated asset, Bitcoin is probably number one. Again, good advantage for the small guy. It's not something the big hedge fund manager can do just yet. So that one other thing that I did want to mention here as well, as we go through those points, in terms of cryptocurrency, it'll come to me in a second. There's a couple of other slides I wanted to show you first as well, because this all started off from a great question that we had in the group from someone asking about, how is this going to affect cryptocurrency? And for the first time ever, I think Bitcoin has its chance to shine. So this is the point that I wanted to talk about now. The fact that it's uncorrelated. Remember during the big sell-off, how Bitcoin went down with everything else that I just showed you before. This is its chance to say, well, sorry, I'll swap charts here so it's a little bit less clutter. This is its chance to say, I'm here. I didn't crash and burn in the last market sell-off. I did go down with everything else because people were quite fearful about how Bitcoin would react. Now, since then, it's been on a huge run. It's had a bit of a correction recently, and there's a lot of people that have been waiting to buy the first dip that we get. And probably the most interesting thing that we saw overnight was that not necessarily all that money that came out of the stock market went into the bond market. And you say, well, where else can they go? Yes, a lot of it went to the US dollar, but then there's those fears about the US dollar. Now, did a lot of it go to gold? No, gold had a pretty bad red day. And so the question now becomes, how much of that money could Bitcoin and maybe other crypto assets possibly absorb? Because we know there's record amounts on the sidelines. We know insiders are selling at a record pace. And these aren't black swans. It's not a market shock that nobody saw coming. These are things that people have time to think about. And as I said, this is very interesting because for the first time ever, there's going to be a certain percentage of investors that say Bitcoin meets all the criteria for the type of asset that we need. Maybe in the past it might have been gold or US dollars or government bonds, but now whether it's maybe even ETH or stable coins where you can get a high yield, there's a percentage of investors all around the world that are going to maybe look there. Don't shrug your shoulders when you can get 10% in a DeFi account when you're facing these, 0% or negative interest rates in some countries still, all this high inflation that the Fed are now welcoming. So you need to find a high yield just to just break even in the modern world. So look, I won't make this too long. I'll probably wrap it up there. But these are very, very interesting times, and Bitcoin has now had, I think, nearly 25% correction. So it's starting to get pretty interesting. A lot of people, I think, are waiting to buy, the low 40s or $40,000. That would probably be a bit of a gift. Um, I don't think markets are going to crash necessarily. I think the Fed will probably bend the knee like they always do, and they'll roll out someone to speak and keep the markets happy. But I'm most looking forward to seeing if Bitcoin can kind of react a little bit differently to how it did this time last year. And if that starts to take off and the news cycle picks up that Bitcoin is absorbing money because of these fears in the stock market, that is another bullish catalyst. It's a fresh lease of life. It's another feather in Bitcoin's hat as a mature asset class. So, look, I'll wrap it up there, guys. Hopefully, that's some quick off the cuff thoughts that you've enjoyed, and I'll talk to you again soon. Cheers.